first of all, we've been really excited, frankly, despite the challenges within the real estate credit market. We're really excited about the opportunity set that is ahead of us. So I think that's why we've been very focused on resolving and recycling our capital so that we can deploy fresh equity into today's really exciting real estate credit market.
Joining me today is Doug Bouquard, CEO of TRTX. So Doug, as headwinds continue to put pressure on real estate credit and equity markets, what steps has TRTX taken to enable itself to respond?
Sure. Well, first, really at the top of our list, generally speaking, has been liquidity. I think really liquidity is what provides sufficient flexibility for us to navigate this current market. So I really put that at the very top. I would say secondly, taking advantage of the fact that we are, a part of a very large real estate platform. So frankly, getting a lot of the synergies and information flow and insights from just the broader TPG real estate platform and also TPG more broadly. I think those two are critical. And then, I would say lastly, I think it's really been, being really front-footed and being really objective about what is happening in markets. And I think we were, relatively early last year highlighting, both the challenges within real estate capital markets and also within the office sector specifically. So I think that what we, expect to do going forward is to, really follow those same guiding principles about, being, really rational about where things are in the market and maintaining appropriate liquidity to be able to navigate the current cycle.
How active has TRTX been lately in terms of originating new loans, and are you focusing more on certain property types?
Sure. So since the end of March and the prior year, TRTX has deployed about $1.4 billion of debt capital into the space. And I would say that we've been primarily focused within multifamily. We still have the belief, as we have for a period of time, that multifamily, even with the fact that cap rates are wider within multifamily, values are lower, from a lending perspective, if you're able to have an entry LTV of 65%, that provides sufficient cushion in terms of even a further deterioration in terms of value. So we really like multifamily, generally speaking. I'd say we're also increasingly looking more and more at industrial. I think as banks have pulled back, who really, I'd say, we're sort of dominating a lot of the industrial lending. We are more and more seeing industrial transactions that we do like.
And what do you see as some of your top priorities for the rest of 2023 and into 24?
Yeah, look, I think, first of all, we've been really excited, frankly, despite the challenges within the real estate credit market. We're really excited about the opportunity set that is ahead of us. So I think that's why we've been very focused on resolving and recycling our capital so that we can deploy fresh equity into today's really exciting real estate credit market. And then, I would say, secondly, from a day-to-day focus, it really is striking that right balance of what I would describe as playing offense and defense across our platform, where we're, really thoughtful and diligent in terms of asset management, acknowledging that we are in a more challenged market cycle, but then also being able to play offense given our liquidity on our balance sheet, where if we do find investments that we do deem to be very attractive, that we're able to, pursue those aggressively.